At some point in this channel's comments section, someone is going to ask the question this video is about. Is now a good time to invest in real estate? And my honest answer is, that's not the right question. Not because the market environment doesn't matter, it does. But because, is now a good time, is a market timing question, and market timing in private real estate is a fundamentally different exercise than in public markets. And the historical evidence suggests most investors who try to time their way into real estate do worse than those who invest consistently and select well. In this video I'm going to make the case for deal selection over market timing, explain what the current environment actually means for passive LP investors, and give you a framework for evaluating whether any specific deal makes sense, in any market. First, why market timing is a bad framework for LP investors. In public markets, timing is theoretically possible because markets are liquid and prices are continuous. You can see the price every second and trade in and out. Private real estate is not liquid. You can't exit a syndication in a bad quarter. The investment horizon is 5 to 7 years regardless of what the market does. Timing your entry means trying to predict the environment in year 5 or 6, not just today. Nobody can do that reliably. What's more, the private real estate markets don't move in lockstep with public markets. A deal that closed in a challenging macro environment may hold through that environment and exit in a better one. A deal that closed at the peak of a favorable cycle may exit in a down market. The question, is now a good time, implies you'll know better later. Most investors who wait for the right time to invest passively are waiting for a certainty that never arrives. What actually matters is not the market. It's the deal, the underwriting, and the operator. A conservatively underwritten deal, one that stress tests for rent declines, underwrites cap rate expansion at exit, uses fixed-rate financing, and carries adequate reserves, can generate strong LP returns in a challenging market environment. An aggressively underwritten deal, one that assumes rent growth above current market trends, projects cap rate compression at exit, and is financed with floating-rate debt, can destroy LP value even in a favorable environment if the assumptions don't hold. The difference between a good LP investment and a bad one is not primarily the macro environment. It's whether the underwriting is honest and whether the operator can execute. That's always been true. It's especially true in markets where conditions are less certain. Let me give you an honest read on the current environment as of early 2026. Interest rates remain elevated relative to the pre-2022 decade. This affects real estate in two primary ways. First, debt cost. Deals financed today cost more to service than deals financed in 2020. This compresses cash-on-cash returns unless the income supports it. Second, cap rate pressure. When the risk-free rate is higher, investors demand higher returns on real estate, which means cap rates have moved up in most markets. A property that sold at a 5 cap in 2021 may now trade at a 6 or 6.5 cap. This compresses exit proceeds on deals that were purchased at lower cap rates. Deals that closed between 2020 and 2022 with short-term floating rate financing are under the most stress. Some of those are working through refinancing challenges, extension negotiations, or worse. Deals purchased today, in a higher cap rate environment, have different underwriting inputs. The starting point is more realistic. The risk is in assuming rates compress back to 2020 levels in the hold period. What does this mean for LP investors evaluating deals today? There are three things that matter more in this environment than in a low-rate period. First, fixed-rate financing or a well-structured rate cap. Floating-rate debt has been the source of most distress in the 2023 to 2025 syndication environment. GPs who bought with short-term floating debt assumed rates would come back down. Many are still waiting. Any deal you evaluate now should have fixed-rate financing, or a rate cap that provides a ceiling on the floating rate through at least the projected hold period. If the GP is pitching a deal with unhedged floating rate debt, walk away. Second, conservative rent growth assumptions. Rent growth has moderated significantly in most markets from the 2021 to 2022 pace. Some markets are running flat or slightly negative. Any deal projecting 3% or more annual rent growth in a market where actual data shows flat to 1% is embedding optimism into the return. Ask the GP what the actual rent growth has been in that submarket over the last 12 months, and how their model compares. Third, a DSCR at stabilization that provides real cushion. With debt costs higher, DSCR is thinner on many deals than it was in 2021. A deal that projects a stabilized DSCR of 1.15 has almost no cushion for any income shortfall. In this environment, I want to see 1.30 or better. The framework for evaluating any deal in any market. Ask 5 questions. 1. Is the debt fixed or floating? If floating, what is the rate cap structure and when does it expire? 2. What are the rent growth assumptions? How do they compare to actual trailing 12-month rent growth in the submarket? 3. What is the exit cap rate assumption? Is it higher, equal to, or lower than the going-in cap? Why? 4. What is the stabilized DSCR? What does it look like in a downside scenario, 20% revenue shortfall? 5. What is the GP's track record in similar market conditions? Have they operated through a challenging rate environment before, or was their track record built entirely in the favorable period of 2012 to 2022? These 5 questions don't tell you whether now is the right time to invest. They tell you whether this specific deal is underwritten for the conditions it's actually in. The right question to ask. Instead of, is now a good time to invest, ask, is this deal constructed to survive if conditions stay difficult for 2 more years? A deal that can service its debt, maintain occupancy, and preserve LP capital through an extended challenging period, while potentially underperforming initial projections, is an acceptable LP investment in any market. A deal that requires favorable conditions to survive, rising rents, compressing cap rates, falling rates, is a bet on the macro environment, not a real estate investment. Your job as a passive investor isn't to predict the market. It's to evaluate whether the deal you're looking at is built conservatively enough to survive the market you don't want, and to perform well in the market you do want. One final point on timing for W2 investors specifically. The best time to invest in your first syndication was when you first qualified as an accredited investor and had the capital to deploy. The second best time is now, on a deal that meets your standards. Waiting for better conditions has a real cost. Capital sitting in cash or low-yield accounts is not building passive income. Time in the market, compounding distributions, and the education you gain from being a live LP, none of those accrue while you're waiting. If the deals you're seeing don't meet your underwriting standards, don't invest. That's a valid response. But, the market isn't perfect, isn't the same as, there are no good deals. Good operators build deals to work in difficult conditions. Your job is to find them and vet them carefully. Here's the summary. Market timing is a poor framework for LP investors in private real estate. You can't exit quarterly. Conditions in year 6 of your hold matter more than conditions today. What matters? The deal, the underwriting, and the operator. A conservatively underwritten deal with an experienced GP can generate strong returns in a challenging environment. An aggressively underwritten deal can fail in a favorable one. In the current environment, look for fixed-rate financing, conservative rent growth assumptions, and DSCR cushion above 1.30 at stabilization. The framework, 5 questions about debt structure, rent growth, exit cap assumption, DSCR in downside, and GP track record in difficult conditions. The right question is not, is now a good time? It's, is this deal built to survive if conditions stay difficult? The LP due diligence checklist, full 20-question framework, is linked in the description. Free download. This has been the Financial Systems for W2 Builders series on passive real estate investing. 20 episodes covering everything from your first syndication to deal distress to building a portfolio. If these videos were useful, subscribe and share them with someone who's been asking these questions. The description has every resource mentioned in this series. Thanks.